We're back here on Morning Trade Live. Uber will be in the spotlight tomorrow morning when it reports earnings ahead of the open. Analysts are expecting adjusted EPS of 79 cents on revenue topping $14 billion. The stock is little changed in 2026 and up 16% over the last 12 months. So let's go inside out on Uber ahead of these earnings. We are trading currently lower by about 3%. Joining me now, I'm very pleased to say, is Scott Devitt, Managing Director, Equity Research at Wedbush Securities. Scott, so nice of you to join us. What are you expecting from the numbers?
Good morning. So we're expecting another strong quarter from Uber, around 20% top line growth, 17% EBITDA margins, and likely a decent guide into 2026. I think, the challenge that Uber faces is just the narrative, this emerging narrative around autonomous vehicles and whether the business can stand up to that or not. But I think the short term's pretty constructive. The longer you look out, I think the more risk that there is.
Yeah, so obviously you've got Waymo and then some of the updates with respect to Tesla giving this a bit of a run for its money. I mean, what's got to change here? I mean, how much of a challenge does this pose, do you think?
Oh, it's significant and it's understated. I think that anytime you have a new technology that's kind of, about to permeate an industry, there's an endless number of perspectives in terms of what could happen. But the reality is likely going to be that the industry is going to have fewer suppliers of rides, most notably in the US, likely to be dominated by Waymo and Tesla. And even if there's more of a proliferation of that, there's going to be quite a contraction on Uber's take rate because with supply concentration, it leads to lower take rates. So I think you're going to be going from a very fragmented industry from a supply standpoint to one that's more concentrated, which at a minimum has a degradation on the take rate and at a maximum leads to significant volumes exiting the platform and going direct.
So you've got a neutral rating with a $78 price target here, which is where we're currently trading right now. Is the competition and the concentration risk the only reason why you're sitting on the fence here?
Yes. Yeah, I think we're focused on the longer term impacts on the business. Like I said, I think the short term, dynamics of the business, as long as the economy is doing well, GDP is growing, consumers are traveling, Uber and Lyft are both doing well. But I think, there's a terminal value risk here that, the market's pricing in on and off, but I think it's potentially more damaging, than the market perceives, which is why our target price on both stocks is basically flat for the next 12 months.
Right. And is there anything that this company can say, do you think, that there's or tomorrow morning rather, that's going to move you off the sidelines, that's going to make this a screaming buy?
Well, I think that you'll hear Uber continue to talk about its positioning in terms of autonomous vehicles itself with partnerships, capital light model that they've chosen to embark on with autonomous. But I'm not sure that there's anything for myself personally that can get me over the hump because I don't think that many of those partnerships really are positioned to scale relative to the two leaders, in the market in the US, which is Waymo and soon to be Tesla as well. So it would take, quite a bit to change that view.
Okay, so the challenge no doubt posed to both of these names, Uber and Lyft, but when you compare both of these names, how is one positioned versus the other right now?
So I would say Uber is the better positioned of the two. One, because it's a global business, so you have different dynamics that are emerging autonomously, and in some markets, Uber may do better with autonomous than other markets. So you have the global benefits of Uber. You have a relative scale advantage that Uber has in rideshare in terms of that it's significantly larger than Lyft. And Uber also gets 50% of its gross bookings from the delivery business as well, whereas Lyft is predominantly, not exclusively, but predominantly a US business and it's rideshare only. So, Lyft is the one that's most exposed here, but I think both companies are, given the very high ratio that Uber itself has for ride sharing in the US market.
Scott Devitt, really appreciate the preview. Thanks so much for joining us today. That is the Managing Director, Equity Research over at Wedbush Securities. Appreciate your time. Well, let's trade it now with Tom White, host of Fast Market. And we're looking at Uber, obviously, as it's going to be report. What's an example trade? Talk us through the approach here, Tom.
Yeah, with the stock in bear market territory, the bar's pretty low on this one, Sam, going into earnings. Implied volatility levels pretty elevated at this point. The option market priced in about a plus or minus 7% move either way, about $5.50 in either direction on a one-day move. Your guest mentioned he's neutral with the price target of 78. I mean, we're right here at this point. So I looked at a strategy that's neutral to bullish. And it takes advantage of, it's type of a twofold trade. It's a cash secured put. It's neutral to bullish where, hey, I can put a bid in on the stock down at $73, and I might not ever get filled on that bid if I try to buy 1,000 shares or 2,000 shares. So this strategy uses the option market where, hey, even if it doesn't go down to 73, I can still profit on a trade with the expectations, hey, it's not going to fall much more than the 23% it is from those all-time highs. So I went out to the February 20th monthly option. So 17 days to expiration, not a pure earnings play, gives myself a little bit of duration. I'm going to sell the 75 strike put. You're going to collect a credit of about $2, right? That's what you can potentially make on this, just $200. But see, you can see here from the risk profile, it takes my break even all the way down to 73. That's about nearly 7% below the current share price, about that one standard deviation that the option market's, pricing in at this point. So I mentioned it's twofold, right? So there's two ways that I could potentially profit on this trade. Well, if the stock stays here, goes higher, or even goes lower but remains above 73, I can be profitable on this because of the credit that I'm collecting. Now, I've got a lot of risk on it if the stock were to somehow go to zero, right? Because you have to buy the shares if the stock falls below 75 into expiration over the next 2.5 weeks, where hey, I might get to buy the shares at a discount if the stock does fall, and then I own the shares, and then if the stock rebounds. So there's a potential couple ways here that you can look at this type of trade where I just want to keep elevated option premium by selling that put, or if the stock does fall post-earnings or over the next 2.5 weeks, I'm willing to buy the shares at a 7% discount to where they're trading now. So this might be the way to look at it if you want to potentially own the shares.
Okay, got you. A good example trade and approach for us ahead of these earnings that come tomorrow. Uber currently trading down 2.5% at $78 and change. Really appreciate it, Tom White. Thanks so much for that.